I look for relatively strong growth in the third quarter. It's not really going to snap the US out of its slow recovery, but it's better than the numbers we've been seeing of late. Dean Maki, Point72. The Bank of Japan have again been criticised this week for doing the same thing over and over again and expecting different results. To what extent, though, do you believe it is finally time for the BOJ to change tack?
In my view, the Bank of Japan has adapted their policy to a different regime. So the Bank of Japan actions this week were quite innovative and different from what other central banks have done. In particular, targeting the 10-year yield at 0% is quite a change in policy, and I think is something that is different from what's been tried there before. So the reason this is so significant is it really gives a green light to fiscal policy. Fiscal policy can expand as much as the administration wants in Japan, and the 10-year rate will still be stuck at zero. So if the deficit goes up significantly, spending is increased, taxes are cut, it won't have an effect on interest rates, at least at the 10-year yield. And that is reversing the usual laws of economics where fiscal stimulus would lead to higher rates. That won't be the case in Japan. So I do think that this action has the potential to make a significant difference in Japan over time if it is accompanied by fiscal stimulus.
Okay, well, economic growth in the US was less sluggish than had been thought previously in the second quarter, suggesting hopeful signs for the future. In light of the data released this week, how would you describe economic sentiment at present?
Well, the economic growth in the U.S. is still on the steady, slow pace it's been on. We did have a slowdown over the past year, down to 1.3% year-on-year in the recent quarter, and that's going to be reversing going forward. I look for growth of about 3% in the third quarter, so we are going to see stronger numbers show through. The groundwork for that has already been laid in that consumer spending grew 4.3% in the second quarter. So even though overall growth was quite weak, consumer spending, which really is the fundamental driver of the economy, was quite strong. And everything else was soft in Q2. Essentially in Q3, consumer spending won't be quite as strong, but it'll still be solid, and everything else largely is going to pick up. So, for example, inventories were cut in Q2. That is unlikely to continue into Q3. Firms are going to have to build some inventories, and that'll give a boost to GDP growth. So I look for relatively strong growth in the third quarter. It's not really going to snap us out of the slow, steady recovery, but it'll be better than the numbers we've been seeing of late.
And lastly for today, in the run-up to the US elections and much anticipated December interest rate announcement, which other key indicators will you be keeping your eyes on?
I think, as is often the case, I think the employment report in the U.S. will be a key. If that shows through into solid growth, another drop in the unemployment rate, as I would be expecting, that should firm up expectations for a rate hike later in the year. It probably would still be okay for risky asset markets because it would confirm the U.S. economy is continuing to grow at a steady pace, and the Fed's not going to be extremely aggressive in rate hikes. We've seen that repeatedly over the past couple of years. So I think the payroll report is going to be an important indicator. Another one that will matter is the ISM manufacturing index. The manufacturing sector has been sluggish through this recovery. That ISM number fell below 50 last month. It would be a positive for market sentiment if that were to bounce back above 50 in the September numbers.
Thank you for joining us today, Dean. That's all we have time for today. I'm Sam Meredith, and be sure to join the Dukascopy TV team once again next week. Have a good weekend.